Oil prices have jumped. US Treasury yields are down, as are US stocks. But the US dollar is up in a flight to safety after reports Iran has launched missiles at Israel. The US labour market is showing signs of resilience, while rate cut expectations in Europe have been boosted by lower inflation overnight. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Economist Maddy Dunk discusses how sales in the lead up to Father's Day in Australia helped retailers in August.
We and the RBA will be looking very closely at whether this lift in retail sales is a blip.
But first, in 5 and 5 with ANZ, oil prices have jumped over 4% overnight. The yields on US Treasuries are down 6 to 10 basis points, and the US dollar index is up about 0.5% this morning. All on reports, Iran has launched a missile strike on Israel. As of 4 a.m. Sydney-Melbourne time, the news had also sent the S&P 500 down more than 1%, and the Nasdaq was down around 2%. That comes as underlying data in the US indicates the labour market is retaining some support. ANZ head of G3 Economics, Brian Martin, says a 329,000 rise in US job openings, JOLTS, in August, point to a firm September labour market report later this week.
We're not at a situation where we are seeing demand for labour really weak, and that's going to drive a demand-deficient rise in the unemployment rate. From a growth perspective, I think that's good news. I also think it fits with the guidance we had from Fed Chair Powell earlier this week, that if the economy continues to unfold in line with expectations, that would merit 25 basis point rate cuts over the remainder of this year rather than 50 basis point rate cuts.
As of 4 a.m. Sydney-Melbourne time, that flight to safety for the US dollar saw the Australian dollar down 0.6% at 68.74 US cents, while the Kiwi was down 1.1% at 62.78 US cents. Number 2, rate cut expectations in Europe were boosted overnight by data showing September inflation rose 1.8% from a year ago, the first time it's fallen below the European Central Bank's 2% target since April 2021. Brian says the key news was that core CPI of 2.7% was already below the ECB's recently published forecast for 2.9%.
That suggests to me that there is a broader disinflation taking place that's occurring a bit quicker than the ECB anticipates. We have a 25 basis point rate cut penciled in for the fourth quarter of this year. So we just want to see another few pieces of data before determining what the actual timing of that will be. But I think it's very clear that the direction of travel for euro area interest rates is down.
Number 3, Australian building approvals fell 6.1% in August, driven by a 16% fall in unit consents, which includes apartments. ANZ economist Maddy Dunk says this is something that's caught the attention of the RBA recently, and it's pointed out that builders focused on high-density projects are finding it challenging right now.
They're dealing with cost pressures, margin pressures, the inability to find labour, and in particular on those high-density projects, they're finding that there is a lot more competition with the major projects pipeline, and there is a large infrastructure pipeline there, which requires a lot of the same skills. You need the same sort of tradespeople for a lot of these roles, so there are some real capacity constraints playing out at the moment.
Number 4, Indonesia's annual inflation eased more than expected to 1.84% in September due to lower food prices. Although ANZ economist Crystal Tan says core CPI at 2.09% was stronger than expected.
The big picture here is that price pressures in Indonesia are benign. They're not a hurdle to monetary policy easing. Instead, it's going to be global market conditions and the rupiah trajectory that will have a bigger influence on the pace of Bank Indonesia's rate cutting cycle.
Number 5, Japan's Tankan business survey was more positive than expected in September. ANZ FX analyst Felix Ryan says the survey's inflation expectation measure at 2.2% annually in 5 years' time is closely watched by the Bank of Japan, which has a 2% inflation target.
So alongside evidence of firm wage growth, recovering consumer spending, this does paint a relatively optimistic view of the Japanese economy and does support further Bank of Japan policy normalization. We also had Bank of Japan summary of opinions from the September meeting. Essentially did show that the Bank of Japan is cautious with regards to communicating further policy moves and policy normalization. Some members did note downside risks remaining for both the global and Japanese economy. That said, though, still clear support for further normalization by many board members, some arguing for a gradual increase in interest rates to 1% by the second half of the 2025 fiscal year in Japan.
Felix Ryan there. Now, in our bonus deep dive interview, ANZ Economist Maddy Dunk analyses the broad-based 0.7% rise in Australian August retail sales, the strongest since January, and whether Stage 3 tax cuts will keep supporting spending against a backdrop of an ANZ Roy Morgan Consumer Confidence Survey showing little sign of breaking higher.
All states and territories saw a rise in retail sales in August, and apart from the household goods category, which performed particularly well around the end of financial year sales period, all other categories in the retail sales data recorded increases in August. Now, it's likely that the boost to household disposable incomes coming from the Stage 3 tax cuts and cost of living measures did flow through to a pickup in spending in August. There was a range of sales events in August. We had the Afterpay Day sales, Father's Day was on September 1, and there were a range of sales events associated with Father's Day. So a lot of that spending related to Father's Day was likely to have been captured in August. Now, in terms of what it all means, I think the data was definitely strong, but the real question is it going to be sustained? And that puts a lot of impetus on what we see in the September data. I think we and the RBA will be looking very closely at whether this lift in retail sales is a blip or the start of an upwards trend in spending. And we have been expecting for some time that the boost to household disposable incomes coming from the tax cuts and cost of living measures would support a pickup in spending. So our ANZ Roy Morgan consumer confidence measure has increased, but we haven't seen a material and importantly a progressive improvement in confidence. So it is likely that that uplift in spending is going to be a bit of a slow grind as we move through the rest of the year. Many households are going to be waiting out for end of financial year sales events like Black Friday, and we know that Black Friday has become increasingly important on the retail calendar. And for the RBA, I think that they will take interest in today's number, but they'll be looking at whether it's the start of a trend and to determine that we really are going to see a few more strong prints in the coming months.
So we did get the latest ANZ Roy Morgan Consumer Confidence release on the same day as retail sales. What did that tell us about how consumers are feeling in the here and now?
We saw that ANZ Roy Morgan Consumer Confidence declined 2.9 points last week after the RBA decided to keep the cash rate on hold, and the decline was broad-based, so all sub-indices declined, but in particular we saw a sharp fall in households' confidence in their current financial conditions. That sub-index dropped 6.7 points, which was a very sharp fall. We also saw that inflation expectations declined 0.3 percentage points after the monthly CPI indicator showed that headline inflation fell back within the RBA's 2 to 3% target band. Now, there's some caveats around that. We know that energy rebates are helping to lower headline inflation, but nonetheless, that is flowing through to inflation expectations. They're currently sitting at 4.6%, which is their equal lowest since September 2021. So the RBA would likely welcome the progress that we've seen on the inflation expectations front. And then in other news on consumer confidence, one of the trends playing out at the moment has been confidence across the different cohorts. So we've seen some shifting dynamics there. At the moment, the 4-week moving average of confidence amongst renters is now below that of households who are paying off a mortgage. And confidence amongst these two groups has been moving around for the last year or so. Over the last couple of months, we've seen that confidence amongst renters has been higher than homeowners. Now, this has flipped, and those people who are paying off a mortgage are now feeling slightly more confident. That might be a sign that they can see some light at the end of the tunnel. In the RBA's meeting last week, they did wind back their hawkish stance slightly, and the governor acknowledged that the RBA board did not explicitly consider a hike at its meeting. So that might be giving those people paying off a mortgage some confidence that there's light at the end of the tunnel.
Maddy Dunk there. That was 5 and 5 with ANZ for Wednesday, October the 2nd. Catch you tomorrow with ongoing reaction to these events in the Middle East. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. please view the podcast disclaimer available via your media player or email.